Most people see their income in retirement, their taxes, and their health insurance as three separate things, three different conversations, three different to-do items on their retirement checklist. Guys, that's a big mistake because these three things are deeply connected. One decision in any one of those areas ripples through to the other two. Get the income strategy wrong and you end up in the wrong tax bracket. Land in the wrong tax bracket and you lose your Affordable Care Act subsidies worth thousands of dollars a year. Or you get hit with a Medicare surcharge you never saw coming. I've got the framework for how you think about all three of these together and what to actually do about it. I've got that and more coming up. Guys, this is one of the most misunderstood areas of retirement planning I've ever seen. People spend years focusing on getting to a number, building up that nest egg, and they don't spend nearly enough time thinking about the withdrawal strategy, their retirement income plan. How are you going to take income in retirement? From which accounts? In what order? And in what amounts are you going to withdraw? Those decisions don't just affect your cash flow. They affect your tax bracket. And your tax bracket affects your health insurance premiums. Guys, this is one big connected system. Let's walk through it, three pillars, and how they all fit together. Pillar number one, your retirement income. The first thing you need to do is build out that real retirement income plan. Not just how much you're going to spend, but where the income is actually going to be coming from. For most people, it's some combination of Social Security, maybe a pension, most likely not, and then withdrawals from your IRA, the IRA that you rolled your 401k into, and then maybe supplementing that with a non-retirement account, maybe some inheritance, something like that. Here's the big thing. Not all income, not all withdrawals are created equal, at least not from a tax standpoint. Social Security, yeah, there's a calculation where this depends on your other income, can be taxed between 0 and up to 85% of it being taxable. Withdrawals from a traditional IRA or that pre-tax 401k, they are fully taxable as ordinary income. Roth IRA withdrawals, those are tax-free and they don't count in most of these income calculations. The mix of income you choose changes everything downstream. And I especially want you to pay careful attention to what I call the gap years, the years before age 65. If you happen to retire before 65, before Medicare kicks in, and maybe even before you turn on Social Security, you have a window, the gap years, where your taxable income is genuinely low. Your retirement income is sound, but very little of it lands on your tax return. That window is one of the best planning opportunities in your entire financial life, and many people miss it entirely. And that leads us right into pillar number two. Retirement income flows right into taxes. Here's what you need to understand about taxes and retirement. Your income plan is your tax plan. They are not two separate conversations. Every dollar you pull from your IRA, from your traditional IRA, it's taxed at ordinary income tax rates. That income sets your tax bracket. Your tax bracket determines whether capital gains are taxed at 0% or 15%. And pulling money from your IRA whenever needed, sort of willy-nilly without a tax plan, that creates some big tax surprises down the road. I'm talking IRMA, the income-related monthly adjustment amount on your Medicare. The Medicare surcharge you pay if your income is above certain thresholds. And here's the kicker, and why this can be such a big surprise. They look back 2 years, meaning your income in 2026, this year, determines your Medicare surcharges, whether you'll be subject to them in 2028, long after you've sort of forgotten about this tax year and the decisions and the needs you have right now. A Roth conversion you do this year, which might absolutely be the right long-term move, could spike your Medicare bill 2 years from now. It doesn't mean don't do it. It means have a plan. And that's why those gap years are so valuable. If income is really low early in retirement, that's the window to do Roth conversions at a low tax rate. Before Social Security turns on, before you start required minimum distributions, before IRMA becomes a concern. That window doesn't stay open forever. And that leads us right into pillar number 3, and that is your health insurance, the piece that ties all of this together. If you retire before age 65, you've got a gap before Medicare. And that means you're likely getting your health insurance through healthcare.gov or the Affordable Care Act. And that means, daisy chain together, that means your modified adjusted gross income directly impacts what you pay for your health insurance. Not in 2 years, like with IRMA, but in real time, trued up on your tax return. Your premium subsidy, as they call it, on the Affordable Care Act marketplace is based on your income today. The lower your modified adjusted gross income, the more subsidy you qualify for. That can be worth hundreds of dollars a month. And so where does your modified adjusted gross income come from? It comes from your income plan, right? That shows up on your tax return that impacts these premium tax credits. A large Roth conversion raises it. A big IRA withdrawal raises it as well. But living expenses, drawn from cash in your brokerage account, it doesn't impact it. Even wise withdrawals from your Roth, those don't impact it either. So the choice of where you're going to pull that income from and how much you withdraw, it impacts your taxes. Your taxes change how much you pay for your health insurance every single month while you're waiting to be on Medicare. Income, taxes, and health insurance, all one system. And that's why you need one plan. Looking at these 3 areas in a connected way like they actually are, really looking at all 6 areas of your financial life, that integrated approach is what gives you the clarity and confidence leading to calm in retirement and calm when making these big decisions. So work with your certified financial planner on that to ensure that those all fit seamlessly together in one plan. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.